Watch exactly what happens when massive, unstoppable market momentum suddenly hits an invisible wall. It's a violent halt. You see this play out in the real world constantly. Look at the S&P 500 ETF here. Trillions of dollars in volume drive the price up, and then it stalls right at 598.42, struggling to cross that massive 600 boundary. There is no mathematical formula or complex technical indicator that tells the market to stop at that specific coordinate. No textbook requires price to pause here. The force halting these trillion-dollar markets is entirely psychological. Traders call these coordinates psychological levels. You'll find them operating the exact same way whether you are charting blue-chip stocks, foreign exchange pairs, or even cryptocurrency. Nobody programmed the global exchanges to respect these specific boundaries, yet millions of independent participants unconsciously enforce them every single day. If there is no line of code instructing the price to halt, what tangible physical force is actually stopping the market from moving forward? It starts with basic human behavior. Our brains are wired for simplicity. When making a fast financial decision, choosing a clean whole number requires much less cognitive load than typing a random decimal. When millions of individual traders operate with that exact same cognitive bias at the same time, we get a structural phenomenon known as order clustering. Normally, limit orders scatter randomly across decimal levels on a price chart, but near a major milestone, they magnetically align on the nearest whole number. When price reaches that coordinate, it crashes into this concentrated blockade of digital contracts and rebounds. A simple human preference for easy math turns an arbitrary price point into a dense wall of liquidity. That wall gets thicker when external amplifiers join in. The first is the financial media broadcasting the approach to a major milestone. When an asset nears a big round number, television networks run the headline. They obsessively cover boundaries like the Dow hitting 20,000, creating a hype cycle that draws a massive surge of retail trading volume exactly to that target. That surge triggers the second, far more aggressive amplifier, institutional algorithms. High-frequency machines are programmed to scan the market for dense pockets of retail activity. The media hype builds the order cluster, and the institutions deliberately target that exact cluster to absorb the liquidity they need to fill their own massive orders. What begins as a harmless behavioral bias is amplified by media attention and then actively weaponized by institutional trading machines. Because of that institutional targeting, it is a mistake to treat a round number as a clean, guaranteed reversal point. These boundaries are actually zones of extreme volatility. This creates the perfect environment for a trap known as the fake-out. Institutions use this tactic to exploit where they know retail traders place their protective stop losses. Let's look at the mechanics on the chart. As price approaches the zero line, a massive cluster of retail stop losses sits waiting. The institutional volume deliberately drives the price up and then spikes just past the whole number specifically to trigger those protective orders. The institutions instantly absorb that newly unlocked liquidity to fill their positions. The momentum dries up, the breakout fails, and the price violently snaps back in the opposite direction. Placing absolute faith in a round number as a protective boundary turns the retail crowd into direct exit liquidity for the professionals. To survive these collisions, you have to map out the battleground in advance. Identify the major round numbers, half numbers, and historical zeros on your chart long before the price arrives. The true edge comes from patience. You ignore the number itself and wait strictly to observe how the market actually reacts after it collides with the boundary. The numerical price flashing on a screen is just an illusion. The only reality dictating the market is the highly predictable human behavior reacting to it.